What are your thoughts on gold? I know you've written a paper in the past that's looked at company valuations with a focus on commodities. How do you see gold set up?
I'll start off with a statement. I don't think you can invest in gold, you can trade gold. And the reason I make that point is gold is impossible to verify. So with gold, there is no underlying fundamental you can point to that can say this is what's going to drive the value of gold. That actually makes gold different from other commodities.
Hi everyone. Welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence.
Gold is considered one of the safest investments, particularly during inflationary periods. Gold prices are almost at an all-time high these days. So, it's a good moment to reflect on gold as an investment. In this video, let's look at top 3 takeaways from Professor Aswath Damodaran's views on gold from an investment perspective. Let's dive in. Professor Damodaran starts by sharing that he agrees with Winston Churchill's views that gold is a riddle, wrapped up in a mystery inside an enigma. He shares that he doesn't understand what moves the gold price and has never held gold in his portfolio. But that does not mean, however, that he is not fascinated by the price of gold and immune from its movements. Takeaway 1. Does gold have an intrinsic or fundamental value? The intrinsic value of an asset is a function of its expected cash flows, growth and risk. Since gold is a non-cash flow generating asset, he argues that you cannot estimate an intrinsic value for gold. It is the same argument that he says applies to all collectibles, Picassos, baseball cards or Tiffany lamps included. If one of the central tenets of value investing is that you should never invest in an asset without estimating its value, that would seem to rule out gold as an investment for a classic value investor. In fact, Warren Buffett has repeatedly argued against investing in gold because its value cannot be estimated. But there is an alternate route that can be used to estimate the fundamental value of a commodity by gauging the demand for the commodity, based on its uses, and the supply. While that may work, at least in principle, for industrial commodities, it is tough to put into practice with precious metals in general, and gold, in particular, because the demand is not driven primarily by practical uses. If you are enjoying this video, please hit that like button so others can find this video as well, and make sure to subscribe to receive next videos. Takeaway 2. What drives gold prices? If gold does not have an intrinsic value, what is it that drives its value? There are at least 3 factors historically that have influenced the price of gold. Number 1. Inflation. If, as is commonly argued, gold is an alternative to paper currency, you can argue that the price of gold will be determined by how much trust individuals have in paper currency. Thus, it is widely believed that if the value of paper currency is debased by inflation, gold will gain in value. To see if the widely held view of gold as a hedge against inflation has a basis, he looked at changes in gold prices and the inflation rate each year from the 1960s. The co-movement of gold and inflation was particularly strong in the 1970s, a decade where the U.S. economy was plagued by high inflation. But taking a closer look at the data, it is clear that gold is more a hedge against extreme, and unexpected, movements in inflation and does not really provide much protection against smaller inflation changes. Number 2. Fear of crisis. Through the centuries, gold has been the asset of last resort for investors fleeing a crisis. Thus, as investor fears ebb and flow, gold prices should go up and down. His analysis does show that gold prices seem to move more with fear in the equity markets than with concerns in the bond market. Number 3. Real interest rates. One of the costs of holding gold is that while you hold it, you lose the return you could have made investing it in a financial asset. The magnitude of this opportunity cost is captured by the real interest rate, with higher real interest rates translating into much higher opportunity costs and thus lower prices for gold. The real interest rate is defined as the observed market interest rate minus inflation rate. His analysis finds that high real interest rates are negative for gold prices and low real interest rates, or negative real interest rates, push gold prices higher. Takeaway 3. Gold as an insurance. It can be argued that the primary rationale for investors holding gold is as an insurance. Insurance against uncommon but potentially catastrophic risks to their assets, from hyperinflation to war and terrorism. Viewed from that perspective, gold operates as insurance for an investor whose assets are primarily financial and thus exposed to these catastrophic risks. This means that if you add gold to your portfolio, it is not to make money, per se, but to buy protection against black swan events that could swamp your other investments. According to Professor Damodaran, if you view gold as a hedge insurance against event risk, there are two implications. First, you should not expect gold to generate high annual returns over long periods. Second, price of gold should reflect the cost of buying the insurance. This will be driven by the uncertainty you feel about the future and the likelihood of catastrophic events. Thus, higher the likelihood of a future crisis, higher might be the gold prices. He also mentions that gold is not the only insurance against black swan events. There are other ways, using other real assets, collectibles, real estate, other commodities, or financial derivatives, including puts on indices, that can deliver the same hedging results, perhaps at a lower cost. He ends his views by sharing that by doing this analysis he recognizes the two sources of his discomfort. First, he is most comfortable with cash flow generating investments, where he can estimate an intrinsic value, and his valuation toolkit is limited when it comes to valuing gold. Second, he doesn't share the fervor that some investors have for gold, who seem to view it as much in emotional terms as in financial ones.
For now, that's it from us. Hope you enjoyed and learned from this video. Smash that like button and subscribe to receive more videos on memos and write-ups from top investors. Thanks for watching.